Today, CoreLogic's national index rose 4% over the December quarter. Hello again, it's Martin North from Digital Finance Analytics. Welcome to the latest post covering finance and prop news with a distinctively Australian flavour. CoreLogic released their updated data to the end of December 2019 today, and they confirmed a 1.1% rise in national dwelling values over the month and a 4% increase over the quarter. This result represents the fastest rate of national dwelling value growth over any 3-month period since November 2009. Darwin was the only region amongst the capital cities and the rest of state areas to record a fall in values over the month, with a decline of 0.5%. And CoreLogic said that although the monthly capital gain trend remained fast-paced, the 1.1% rise in December was softer relative to the 1.7% gain in November and the 1.2% rise in October. This suggests that the pace of capital gains may have been dampened by higher advertised stock levels or worsening affordability pressures through the early summer, they said. On an annual basis, Australian dwelling values tracked 2.3% higher over calendar year 2019, with 5 of the 8 capital cities and 7 of the rest of state regions seeing the year out in positive territory. Among the capitals, Sydney and Melbourne recorded the highest annual capital gain, with both cities posting a 5.3% rise in dwelling values over the year. Regional Tasmania, where values were 6.1% higher over the year, led the regional markets, and values were down in Darwin by 9.7%, 6.8% lower in Perth, and 0.2% lower in Adelaide. And over the year, while values also fell across regional Western Australia, down 11.8%, and regional New South Wales, down 1.1%. CoreLogic said that the positive year-end results mask what has been a year of 2 distinct halves. We saw capital city dwellings fall by 3.8% over the first 6 months of 2019 and then rebound by 7% over the second half of the year. The housing value rebound was spurred on by lower mortgage rates, a relaxation in borrowing serviceability assessments, improved housing affordability, and renewed certainty around property taxation policies post the federal election. Lower advertised stock levels persisted, and that provided additional upward pressure on prices amidst rising buyer activity. Despite a strong rebound over the second half of 2019, property values across most regions of Australia are still well below their previous record highs. The CoreLogic index recorded a peak in October 2017. Dwelling values remain 3.1% below their record high at the end of 2019. But if the current quarterly rate of growth persists into 2020, then the national housing market will record a nominal recovery by March as dwelling values push higher to new record highs. But we'll see. CoreLogic said a nominal recovery in housing values implies homeowners are becoming wealthier, which may also help to support household spending. However, the flip side is that housing affordability is set to deteriorate even further as dwelling values outpace growth in household incomes, signalling a setback for those saving for a deposit. The only regions where housing values are currently tracking at new record highs are Hobart, Canberra, and regional Tasmania. 33 of the 46 capital city SA4 sub-regions have recorded an annual rise in dwelling values through 2019 calendar year, with the top-performing sub-regions confined to areas of Melbourne and Sydney, while the weakest conditions have generally been across Perth and Darwin, as well as Melbourne's Mornington Peninsula and Sydney's Central Coast region. Melbourne's inner east, with a median dwelling value of 1.195 million, is leading the charge, with values up 12.1% over the calendar year. Values remained 4.2% below their August 2017 peak. However, with such a rapid rate of growth, housing values in this area are likely to reach new highs in the first couple of months of 2020 if things continue the way they are. On a quarterly basis, the vast majority of capital city sub-regions have moved back into positive territory. Only 4 of the capital city sub-regions have recorded a quarterly decline in home values, and that includes Darwin and Perth's northwest, southeast and Mandurah. Regional markets have recorded a softer performance relative to their capital city counterparts. Broadly, regional housing values were down 0.5% in 2019, compared with a 3% rise in capital city values. And across the 42 non-capital city sub-regions, 23 areas have recorded a rise in values over the calendar year, and the best performing regions were mixed and included areas of regional Tasmania, which remain extremely affordable for interstate buyers, as well as several coastal lifestyle markets and rural service centres. The weakest housing values continue to be located within the broad outback regions of Queensland and southern Western Australia, where housing demand remains low due to persistent drought and weak economic conditions. The premium markets experienced the fastest rate of capital gains, with the top quartile of capital city dwelling values rising by 5.6% in 2019, compared with a 1.1% fall across lower quartile properties. This trend was most centric to Sydney and Melbourne. Sydney's top quartile properties have recorded a 7% rise in value over the year, compared with a 1.4% lift in values across the lower quartile. Similarly, in Melbourne, top quartile property values are up 7.6%, compared with a 3.7% rise in lower quartile values over the year. The remaining capital cities are generally showing more uniform growth rates across the broad valuation cohorts. In Brisbane, it's the middle of the market recording the strongest growth conditions, up 0.7%, compared with a 0.1% rise across the lower quartile and steady conditions across the upper quartile. While in Adelaide, it's the lower quartile up 1.9%, compared with a 2.2% drop across the upper quartile. And in Perth, it's the middle of the market, which has seen values slightly more resilient to falls, down only 6.6%, compared with the 7.4% drop across the lower quartile. Rental markets held reasonably firm in December, with the national rental index up 0.1% over the month and up 0.2% higher over December quarter. On the annual basis, rents were only 1.2% higher nationally. Although rental growth remains sluggish over the year, conditions have picked up from 2018, where the annual growth in national rents was only 0.5%. The subtle improvement in rental growth comes after a material reduction in investment activity, as well as a slump in new residential construction, implying less new rental supply. Hobart remains as the tightest rental market, and rents are there up 6% over the year, followed by Perth with a 2.1% rise in rents after recent falls, while rents trended lower over the year in Sydney, down 1%, and Darwin down 2.1%. Most cities have seen rental yields compress over the year as growth in housing values outpaced rental rates. Nationally, the gross rental yield slipped from 4% in 2018 to 3.8% in 2019, but there are considerable differences across different geographic regions. CoreLogic believes that in 2020 it's unlikely we'll see such a rapid rise in capital gains as seen through the second half of 2019, despite the expectation that mortgage rates will move lower over the first half of the year. Several factors are likely to act as a counterweight to this stimulus. They cited several factors influencing property market performance in 2020, with housing values rising faster than household incomes. Worsening household affordability is likely to deliver a slowdown in activity across price-sensitive segments of the market, especially in Sydney, where dwelling values were already 8.2 times higher than gross annual household incomes halfway through the year. A rise in investors attracted by prospects for capital gains and a positive spread between mortgage rates and rental yields should, they say, help to offset a reduction in activity from more price-sensitive buyers. High-rise apartment completions are likely to remain higher than average over the first half of 2020 as the surge in off-the-plan unit projects complete construction. Precincts with higher supply levels could face some downward price pressures as new stock enters the resale market, especially at a time when many buyers are cautious of newly built projects due largely to concerns around high supply levels and construction quality. And advertised stock levels are likely to rise from their low base at the end of 2019 as prospective vendors take advantage of the recovery in home values and strong selling conditions throughout spring and early summer. Higher advertised stock levels will provide more choice for buyers and remove some of the urgency from the decision-making process that has supported higher prices. And smaller cities where housing is more affordable and economic conditions are improving may offer some insulation from these downside factors. Jobs growth and population growth is slowing across New South Wales and Victoria, whereas conditions are improving in Queensland, Western Australia and, to a lesser extent, South Australia. Comparatively, low housing prices coupled with higher migration rates and improved job growth could play out positively for the capital cities in these areas. So there's a couple of observations I'd like to make. The first is, of course, that the CoreLogic index is not the only index discussing price movements, and many of the others like REA are not so positive. Secondly, I think CoreLogic is right to call out some of the risks ahead, and my own expectations is that prices will not be rising that fast over the next year or two because of the broader economic issues that we face, and I don't think that the drought and the recent bushfires are going to help either. So it'll be very interesting to monitor prices over the next year, and we'll continue to do that through our various sources, and we'll continue to report the CoreLogic indices as they are produced, but with the caveat, of course, that they are not the only index game in town. I'm Martin North from Digital Finance Analytics. Many thanks for watching, and I'll see you again next time.